And I'm going to let everybody in. Cool. Well, welcome everyone. Really excited for this late afternoon, at least Eastern time, session of our New to VC. I would ask that if you are not one of our panelists, Kirsten and Aaron, if you could hang out off video so we can focus our attention on these folks. And by way of introduction, my name is Charlie O'Donnell, and I am a partner at Brooklyn Bridge Ventures. Early seed, pre-seed, leading, co-leading, super early stage deals in and around the New York area across a wide variety of industries. And we've been doing this New to VC series for a couple of years now, the idea being to help folks who are just breaking into venture or whose next step might be venture, who are thinking about raising, doing some angel investing, maybe think about formalizing what they're doing to try and make this world a little less of a black box and to be a little bit more transparent about how things go. This is especially a good topic on the LP side and the fundraising side, because out of all of the areas in venture, it's probably area least written about, least talked about, kind of left for most of these funds to figure out on their own. And we've got two absolutely terrific GPs here who are who have figured it out and are well on their way, at least on the fundraising side, and who've stepped it up from smaller funds to breaking into the institutional side. So I will let them give short introduction of themselves and their fund. So Aaron, you want to kick it off since you're first in alphabetical order?
Sure. Well, first of all, thank you so much, Charlie, for having me here. And it's a pleasure to meet everyone. Hopefully I can share some knowledge. And it's always a pleasure to be on with Kirsten. At our firm, 645, we really admire the platform that they've built and really look up to them as a firm. So 645 is an early stage venture capital fund. We focus on leading seed and Series A's. We have 3 funds under management now. We manage over 200 million. And last year was a milestone year. 3 of our companies became unicorns. We really focus on enterprise SaaS, infrastructure software primarily, and occasionally we'll invest in consumer.
Cool. And Kirsten.
Thanks, Charlie. It's nice to be here with everyone today. And I think it's really cool that Charlie does this, that you, Charlie, are such a giving contributor to the ecosystem. So I appreciate you reaching out to include me and give me an opportunity to spend an hour with everybody and to be on this panel with Aaron, who I also have a tremendous amount of respect for him and what he's built. We have a common investor who introduced us a couple of years back and have formed a good friendship and opportunity sharing and all kinds of stuff. So this is nice to be here together today. This year, Forerunner is going to celebrate its 10-year anniversary. It feels like I can't hardly believe it's been 10 years because it's gone by as quickly, but at the same time, it also feels like, okay, I've been doing this for a while. We over the progression of the decade, we have increased our fund size, and it's been bottoms up, top down, but it's been deliberate. I definitely wanted to build a team and be able to invest with a group of colleagues. And so that was sort of a goal at the very beginning. And I think beyond that, we wanted to really leverage having a thesis and a thematic approach, and to think about what was the right fund to meet the market for the opportunities that we saw, that we thought we could be good partners for. So we just finished investing out of a $500 million fund. We just raised a $1 billion fund. We kind of historically been very focused on early stage entry point investing, but along the way have been able to follow on either from our current funds or for some special vehicles we put alongside our funds. This new fund is going to allow us to kind of do a little bit of later stage investing, but it will all be, very thematically driven, and a lot of it will likely come from early partnerships that we formed investing at earlier stages.
Cool. Well, listen, thanks for both of you for joining. And first I want to start off because there's a few people in the room who are maybe scraping together a little pool of capital, doing a little angel investing on their own. And the idea of $200 million under management, a $500 million fund, $1 billion fund just seems like so far away. But I just want to, anchor this conversation in terms of what you started with. And so maybe if you could just, Kirsten, if you want to start off, like, what was the very beginning of your startup investing career like? What did you start with?
Okay, so let's see.
When I first met you, actually.
Well, when I mentioned Forerunner and I say we're celebrating our 10-year anniversary, really the milestone that I pegged that to is when we raised our first institutional fund. But the reality is my investing career and even investing in early stage companies started many years before that. I spent the first 10 years of my career on the public market side. I then really felt like I wanted to invest in companies that were more about the future, that were more about growth, that were more imaginative in their approaches, and where I could be an investor, but also leverage like being engaged with people and being closer to the company, something you don't get to do when you're a public market investor, more passive. And the combination of those things led me to being interested in early stage investing. And I started making my first angel investment in 2006. I didn't come from the tech industry, so though there's this whole ecosystem of angel investors, that wasn't really known to me at the time. I just really had a focus, and I found a few entrepreneurs that were operating in that space, and I went and I raised capital and put together individual partnerships. And I always said, like, I don't want to be a banker, I want to be an investor, so I'm going to manage these partnerships and then show up to you and try to be a good engaged investor and be supportive in whatever way I might be able to. I invested in 8 to 10 companies that way, raising a little bit more than $20 million, like off of these one-off partnerships. And when I was doing it that way, it was less, I really put the companies at the forefront to talk about, like, here's the business, here's the founder, here's the market they're playing in. As an investor, here's why I believe in it. And so when people were investing in my partnerships through me, they were really investing in the companies. They weren't really necessarily trusting my judgment. After I'd made, 8 or 9 or 10 of these investments, I wanted to be able to say, like, you've seen some edit or some body of work that I've done, I'd like to have a small angel fund to sort of demonstrate that I've got a take on an early stage pick. And so then I had a $5 million angel fund, which I got together from people that I'd known through 10 or 12 years of investing, and then eventually leveraged that into an institutional fund.
So just out of curiosity, on getting that initial sort of $5 million fund together and then some of those partnerships, did you pick up those investors with a really sort of targeted approach and knew that they were maybe doing deals or whatever? Or was it just, far and wide, however many people you could sort of pass the hat around to?
I was thinking about this a little bit in anticipation of the conversation today, Charlie, because it's like, that's a long time ago when I did this. I hope it's still relevant to today. The ecosystem changes, but I think it probably is, because you know what, like, there's challenges at every juncture of building a business. If you're an entrepreneur, if you're starting a fund or a firm, there's different there's different hurdles or new things you need to kind of meet the moment, whatever fund size you're raising. But the earliest stages ones are probably the very hardest, because you don't necessarily have a body of work to point to. You've got to kind of, think about the ways in which you can help people build conviction, that you can be a good steward of capital, that you can be a good picker of companies, that you can show up for those companies in a productive way. And my earliest, when I just started wanting to partner with entrepreneurs and raise money for them, and all the way through kind of raising my first fund, I really went and talked to everybody who had done it before me, kind of like we're doing now. And I always kind of say, like, the good news and the bad news out of that was like, I got every single person told me a different way to do it. Some people were like, you should just find one entity, one corporate partner, or one partner that wants to give you the bunch of money, all the way to like, people are like, take, $500 from whoever will give it to you because it's a bigger network and it's kind of more ways to get people engaged in what you're doing. And so I think the takeaway from that is there's no right or wrong way to do it. I think you just need to kind of, understand or try your best to understand what you're signing up for when you go about doing it. My first, when I raised money, those individual partnerships, I went to people that knew me. That I felt like there were people I'd worked with before, and my hope was that they could at least value that I could trust Kirsten, and I know Kirsten's working hard and trying hard, and that was sort of the first place I anchored my outreach on. And I wasn't picky about how much money people were giving me. I mean, I think in those partnerships where I say I raised, I might have gotten like $5 or $8 million along the way from somebody or some, fund or something, but I got $10,000 checks from people who I used to sit next to at work. And that was the scariest thing. It was like, okay, these are people who aren't out there being prolific angel investors or whatever. They're trusting me as much as anything. And that felt an incredible amount of responsibility, but it was motivating too.
And you'll find too that the $10,000 check is really meaningful from someone, almost more so than the $250,000 check from some people.
Yep. And I think, I think one of the things that I did from the very beginning and have sort of honored all the way through is just, really being transparent about what's going on with my business or with the company's business, and like figuring out like a way where I can offer people insight into the business they invested in on a routine basis, because otherwise you could spend all your time dealing with your investors too if you just take one-off calls. So you got to kind of think about a structure that you're going to put around how you're going to have ongoing communications as well.
For sure. So Aaron, the 645 origins, tell us about the beginning and how you guys first got into the market.
Yeah, I mean, the similarities are really strong to what Kirsten just said. Our first fund was 7.6 million. Majority of the investors were high net worth individuals that we had met along our careers. So I started my career at Goldman Sachs on the equities program trading desk, building high frequency trading algorithms. So I'm a software engineer. So I did that for several years, went to business school and ended up getting into venture capital at the seed stage in New York. So I was working as an associate at a fund. And while I was there, I saw an opportunity to really change the way early stage venture is done. So I started to recognize that software wasn't a part of the core operation of a venture capital firm. I saw a lot of structural inefficiencies in how venture capital firms were run. And so I thought building a new type of firm that was built on top of a software platform could create a new way of doing early stage venture. And then I met my co-founder, Namdi, who had came out of Insight Venture Partners. And he and I were saying, wow, can you take what Insight did and bring it to the early stage, which is an outbound deal sourcing strategy, right? And so majority of our seed stage venture capital peers source opportunities primarily from their networks, which are geographically constrained based on where you live and where you went to school and where you work. But we say we could augment that opportunity set with, investment opportunities that are outside of our network if we could just find them. So that was like our hypothesis. And then we went to everyone we can find who we had worked with before, who had made money for in the past, and pitched them this idea. And several of the individuals said yes. A lot of people said no. A mentor once told us that you're going to be surprised who says yes and who says no.
True.
And so that came true to us, right? So we were surprised by people who didn't invest because based on what they were saying publicly, it seemed like they would be a perfect fit. And then there were people who just surprised you, who said, you know what, here's $10,000, like Charlie said, or here's $25,000. And that's how it started. And that's what we called our proof of concept fund. And we started what we called building a plane in free fall, right? So we had this small amount of capital that really wasn't sustainable to run a firm and an operation, but we had enough capital to build a track record. And we thought that track record would create the opportunity for us to eventually attract institutional capital. And the other thing that Kirsten said that's really important to us. There's a saying inside of our firm that's the great study the great. So we went to everybody you can possibly think of in venture capital. We sat down with them just to learn. And all of the things we learned, we tried to synthesize them and incorporate the best of what we learned into our firm. Some of those individuals became investors in the fund. Some of them just became investors in the fund through their advice, which was kind of, in our opinion, looking back on it, equally as valuable.
So one of the things that struck me about what you guys are saying is, you know, it would be very easy to be sitting here and think, well, you know, you came from the finance world, or, you know, had connections to capital. But, you know, the thing about finance is just because you know investors doesn't necessarily mean you know investors in the thing that you're raising money around. And so that was my experience. I started out on the institutional side, actually funding VC funds. So you would think that that would be really helpful, except that I was at the General Motors pension fund writing $40-50 million checks into funds. So when you're out there raising your, you know, first, you know, $10 million angel fund, those contacts aren't helpful. Like knowing somebody at the LA County Employee Retirement System for your, you know, $5 to $10 million fund is really not meaningful at all. And so I found out that my network, while financy, was not necessarily the kind of people that went into this kind of thing. And so there was one point in which I literally downloaded my entire LinkedIn address book. And this was back when like LinkedIn actually allowed you to export the emails, which was really useful.
It was.
And I had managed to get to a small close, but I still had most of the funds still left to go. And I literally BCC'd everyone. So one, I learned that Gmail only lets you like BCC 500 people a day or whatever, right? And I just told them like, look, I put this together. Here's what I'm looking for. Here are the kind of founders that I'm looking to fund. Here, they're all looking for talent. So if you know somebody interesting, I would love to make a talent introduction. And the people that invested in me invested for the following reasons. Some of them are kind of inconsistent angel investors. They're looking for deal flow, co-investment, all of this sort of stuff. And Aaron, to your point, it was really surprising who responded. There were people that I was sure that I was going to hear from and didn't at all, or got a very nice like, oh, hey, that sounds cool, good luck, and then nothing. And then like out of the blue, a couple people who were able to make introductions, and I had no idea the kind of networks that they were connected to. So I really realized that I had to up the number of asks that I was making, and it was much easier to ask, do you know anyone who's looking for deal flow of this type or what have you? And the thing that both of you guys said, which I think is really important, is having a thesis, right? Having a, you know, these are the types of deals that I'm going to go after. Here's why I think these companies are going to go, and having a perspective. I think it's something because you're asking people to bet on a blind pool. And so they don't know what is necessarily going in the fund. I mean, Kirsten, you'd put together some SPVs for specific companies, but once you get up to that fund stage, people want to know what they're getting, and it feels a little more concrete, where it's like, oh, you're picking companies of this type. I could understand your thinking of why a venture fund would operate like that and be successful. I think really, really helps versus like, hey, I'm in a particular network and I'm seeing good stuff. Like that doesn't really tell me enough about why you versus, you know, any other type of fund. One question I would have for both of you is, how much, you know, Aaron, you said you thought about like a proof of concept fund. How far in advance were you thinking about, okay, so, you know, now I'm going to raise my initial sort of $7.3 million fund, and then the next one's going to be 20, and the next one's going to be 50. Did you think a couple of funds down the line, and did that affect what type of deals and what stage? Were you trying to build to a particular target? Aaron, if maybe you want to start off there.
Sure. So for fund one, we didn't choose the fund size chose us, right? So we thought we could raise a lot more. And so we landed at 7.6 million. I remember our first close was 3 million. And
that was the size of my first close too, actually.
And we called a third. So we had $1 million. We were this pump that we can actually just start to get to work. And so it took 18 months to raise that fund. By the way, it took 18 months to raise 7.6 million. And when we finished, we were excited that we had a dedicated pool of capital to continue to invest. We had already built a portfolio. We had a company that had gotten acquired while we were fundraising. We had companies that were being marked up. So the evidence was starting to come. And one of our LPs for fund, who ended up becoming an LP in fund two, as soon as we finished raising fund one, he said, now go back to market. We were like, what? Like, that was painful. And he was like, now go back to market. And so then we started to plan, right? So from a planning standpoint, planning is really, really important in our firm. We think of, a failure to plan as a plan to fail, right? And so we started to like sketch it out, right? Like, we can go out and now raise what we thought would be a $30 million fund. And the way we did this, and we got advice from an investor at Horsley Bridge, which is a large institutional investor. And he said, why don't you kind of simulate how big of a fund you can theoretically run based on the amount of allocation you were given in some of these deals. So we ran the simulation and we came up with 30 million was like our effective fund size. So we kind of went out and raised 30 million. Majority of that was individuals until we hit the $30 million mark. We were then oversubscribed, and then we started to get a couple institutions to back us. And then,
so to be really specific about that exercise, though, just so everybody understands, so you went through company by company and you made an estimation, even if you were only able to put, because of your fund size constraints, 200K in a deal, you could make an argument to yourselves that there was 500 available at the time or 750 available at the time that you could have done had you had a bigger fund.
That's correct. So we're super detail oriented firm. We have notes on every meeting that we've had over the last 8 years with every single founder that we've encountered. So when we went out to raise fund two, we just went back to the notes and we can see how much they were raising and how much was available to us at the time. We were constrained, as you mentioned. We had a $7.6 million fund. We were writing checks between 100K and 200K at most, but we had opportunities to put in 500K or $1 million. And so we took that evidence and said, look, if we were able to invest what we wanted to, one, this would be a $30 million fund, but two, this $30 million fund will be valued at 90 million right now, right? And so that was the case that we started to make around why we should be operating a much larger fund. And then when it came down to raising fund three, we started to look very closely at the market. So where is the market going? How do we become a lead investor at the seed and series A? What is the check size that we need to write to get the ownership that we need? The average entry prices were going up. We run what we call a return of fund to exit analysis for every company that we do. And so in order for us to kind of really achieve the return expectations we needed more capital to get more ownership in the companies to be in a lead position. And that led us to raising $160 million fund three.
Gotcha. Kirsten, when you were putting together that initial fund, did you look ahead to other funds? Did you have just a one fund at a time strategy, or did you have a longer term plan?
Yeah, I think kind of like what Aaron was saying really resonates with me, is just being really deliberate at every part of what you're doing. And I would say that every time I have a fund, I've had like, here are the one new thing or the two new things that we're going to try to demonstrate or showcase this time. So but my first fund was a bit different than that. So my first fund was more about demonstrating to myself what the right path was going to be. When I had the $5 million angel fund, I had an open question in my mind, which is, here's the kind of companies that I think I have a point of view on, or that I can connect with and get access to and have conviction to invest in. Am I better off, working at a firm or starting something on my own? And I needed to ask that question because I didn't come from the venture capital ecosystem and I didn't know who all the players were. During that time period, two things happened. One, no one offered me a job. And two, as I started to meet people and learn more about the business, it was this time when there was this burgeoning new group of firms that had started seed funds. And, maybe Jeff Clavier and Softtech had started it 5 or 6 years ago, but there was still just like a handful of funds. Like first round where Charlie was like the most notable. There weren't a lot, but there was enough that you could say like, oh, that's a type of a model I can look to. And I got to know, all of the founders or leaders of those funds. They were part of like sort of my learning set that said like, how do you go out and raise a first fund? And the group that gave, the very all different ideas on how to go about doing it. But I took all that information and thought like, okay, for me, when I went to go raise my first fund, I said, I'm going to look for the LPs that have already backed these other managers, because those LPs have already voted with their dollars that they're open to doing a smaller model, a new model, the seed investing. And I am going to need to prove that like, I have a role in this ecosystem, or that I can be a fund manager. And that's a big enough kind of hurdle to clear. So if I could go to the ones that had already bought into the general kind of like, this is a new model for a firm, then I could focus on my approach to it. And so I got a list of, and then I thought about all the different kinds of LPs you can have. Once you start getting to that place, you kind of learn about like the ecosystem. There's pension funds, there's foundations, there's endowments. And I sort of settled on like one type of LP that I felt like would be, maybe a good domino tipper. And I got a list of them and went out to them and said, I want to build a firm that has a specialty in X, Y, and Z. I have an angel fund that I have as a proof of concept. Here's the kinds of companies I invested in. Here's why I invested in. Even when it was just me with a few $1 million, I wrote an investment memo for every company that we invested in. I, really was focused on kind of what's the investment thesis, like why this team, why this founder, what are the milestones we're looking for. So there was like, kind of a stream of logic around what I was doing that I could follow through and say, here's what's gone on with these companies. And that was sort of, me trying to prove that my edit was good. And so I went for that $40 million with specific $40 million because I looked at the seed deals that I had been a co-investor in and not led, and thought, here's the math. Like these rounds are $1.5 million. They're selling 20%. I need to get 10 or 15. Here's what I need. And so just like Erin was saying, it was like super bottoms up from that perspective. And then when I raised the first fund, and I won't bore everybody with the different milestones every time, but then I said, okay, now I've got this fund, like now I need to I showed with my angel fund that I could make an edit of companies. Now I need to show that I can lead a deal. So then I was really focused on like, how do we, what investment can we lead? What can our role as the lead investor be? And like, there's always so many things you want to do that you have to, one trick is to figure out like, what can I do, fewer things better. And so I couldn't run around town trying to meet every entrepreneur, scrounge up every deal, or whatever. But I figured like when I had a good company, I could really show up for that founder, because good founders know good founders, and that would start building your network. And, that framework has been like a way of thinking about developing the firm over time.
Yeah.
I think the thing that's consistent, go ahead, Aaron.
That's such an incredible framework. I think that's a part of what we admire about you all. But like when you do what you say you're going to do, LPs trust you, right? And when you can take that trust and say, but let me try something else. We have a hunch about this, just like Kirsten is describing, and we've applied the same thing. So when we went from fund 1 to fund 2, we said we can lead seed rounds. When we went from fund 2 to fund 3, we said we can lead seed rounds and series A's. And like, let us test this out. Let us try that. And we are hyper transparent and intellectually honest, first with ourselves, and then with our LPAC and LPs. And when you have that type of rigor, intellectual honesty, and trust with LPs, you can try more and can continue to kind of move the ball down the court.
I think one of the things that's important to keep in mind when you start to move towards institutional investors is that typical institutional investor is going to be on board for, I mean, minimum 2 funds. I mean, you really need to sort of screw up big time in the first fund, not to get somebody to kind of pick you up in terms of doing what you say you were going to do, because there's not enough time for the performance to really kind of roll through. So they are signing up for a long-term commitment. And I think much like when VCs invest in companies, they want to see, like, do you have the intellectual infrastructure, the deal rigor, the process? I mean, the fact that you, Kirsten, wrote an investment memo to who? Like to you know,
to my files.
Yeah. Right. You filed away a memo, even though it was just you as a solo GP, because they're going to ask, right? I used to be on that side of the table, and they're going to say, show us your memos, right? And you don't want to be writing them up, you know, the night before an LP evaluation. Like, it's going to be fairly obvious. They want to see what you were thinking at the time, and want to understand how you're going to change and sort of evolve in the market. Kirsten, you said something interesting that I think people would be really want to know about, and that's you went to who had backed other funds. Now, I'm assuming that if you just went up to a fund and said, hey, who gave you money, that the ecosystem wouldn't necessarily be so open as to share that information, or certainly not public information. So, like, how did you figure out who backed which funds? Or maybe some people were willing to give you a name or two.
You know, Charlie, people must have been willing to give me a name or two, because I don't know how else I would have known it. I mean, I will say, like, very specifically, like, I met Michael Kim, who's the founder of Sandana Capital, who has been an LP in a lot of seed funds. And he was starting his business around the same time I was looking to start mine. In fact, he encouraged me to go raise a fund. Like, you can do it, you can do it. And he knew, like, he had been raising money for his own firm, and he had been invested in some of these other firms. And so he knew who kind of, like, my list was endowments. That's what I went for. And so it was like, these are the 12 endowments that have backed these other funds over here, you know? And so, like, not all 12 of them called me back, but, you know, enough of them did that I got a term sheet from one. And so, you know, I always remember thinking, like, wow, this is, you know, the good news here is that there's, like, a list of investors I can go to, and it's very specific. And the bad news is it's like 12, so I better not screw it up, you know. But yeah, like, I wasn't given an intro to every one of them. Some of them I was cold calling, but I at least could say some context. Like, I know you've backed Floodgate, blah, blah, blah. Here's what I'm trying to do. So they could then say, like, oh, this is, like, how I should maybe think about this type of thing.
And I think to that point, I think it's really actually useful. Sometimes you know of other funds being raised and you feel competitive with them. But speaking from the former LP side, it's actually really useful to be in a cohort of other people to be compared to, because
it's a collaborative business. It really is. I mean, yes, you have to have, you know, there's all talk about sharp elbows and you have to get deals. You have to do that too, but you also have to think about even how you operate that way in the context of the ecosystem, because sometimes you're going to be in the less influential position, and you want to hopefully have friends that will advocate for you, you know, and, like, you're never going to be the only investor around the table. So you really want to spend time on good relationship building, which, you know, yeah.
And I think too, that if you are raising your fund around the same time as a handful of other people that you work well together, chances are you're probably going to stumble upon an LP who's just building out their program, or looking to add a few names at a time. And so, you know, if I'm a VC and one of the people who invested in me said, hey, who do you like working with? Because we would like to put money into other funds. You want to be useful to them. You want to come up with some names, actually. So I know I've made intros to other funds, and I know which ones of my investors are looking to add on more names and which are less likely to
Yep.
add on more names. I want to also talk about team for the moment. Kirsten, you started out on your own. Aaron, you guys started as a team of 2. How did you think about building up team? Did you add team ahead of that sort of next raise to make it seem like you were more substantial and you know, had more bodies to you know, take on more capital, or was it a function of getting the capital and the work necessitated that you needed to build that team?
Yeah. So from the very beginning, we were quite intentional about what we wanted to be in the long run. So we wanted to build one of the best early stage venture capital firms of this generation. Like, so we would say that to ourselves. And we wanted to build an institution. So we knew we would have people working with us, both Nambi and I. So in the very beginning, we brought in an engineer because we built a software platform and we wanted to have engineers in our culture. And we didn't bring them in to make it seem like we were building. We brought them in to actually build. So we started building real infrastructure, like software infrastructure that our firm is built on top of. We also brought in a person who really helped us with brand and design. So not only brand and design for our firm, but kind of brand and design for companies that we were working with. And we pretty much convinced these 2 individuals to work with us for pretty much very little. Nambi and I didn't take salaries for 3 years, and the little management fee that we had, we put into the team members. And so we started kind of punching above our weight class. And then when we raised the first fund, the second fund, the first institutional fund, we had enough capital to start building out more of the team. So we started adding to the engineering team. We started adding to what we call investment and research. So just like Kirsten, we were writing detailed memos for every investment, while our seed stage counterparts, however, were saying, why do you do that? Like, that's not how seed stage works. Like, you just like invest in team and market, and it's like, you don't have to do that. But we were building this culture of kind of really doing research. So we wanted to build an investment and research team. So we started hiring associates onto that investment and research team after the first fund. And then we built out what we call a success team. So the success team is a team that works with portfolio companies on customer acquisition, talent acquisition, and what we call capital formation. So we started to add members to that team who can really be helpful to our portfolio. After we landed our first large institutional investment, which was also an endowment, and the individual from that endowment joined our LPAC, one of the first recommendations that they gave us was
LP Advisory Committee, for anybody who doesn't know.
Yeah. And so they were saying to us, hey, it's probably time for you all to have a CFO, because Nambi and I were literally running everything. I remember the last thing I remember doing that our CFO ended up doing this type of stuff was I got a water cooler for the team, because the team would say, hey, we want a water cooler in here. So we were doing water cooler. We were doing kind of negotiating office space. We were doing all of this work to run our firm. But the recommendation was to get a CFO who can really take that workload from you. So we started to build that infrastructure as well. And that has allowed us to scale quite a bit.
Kirsten, how long did you go on your own before you started to add investment team members?
So I got a term sheet for my first institutional fund, and I called my parents, and then I called Yuri and said, would you like to have a job and come work with me? So, right away, I was like very eager once I felt like I had something that I could offer, somebody who was otherwise had a good job and a good path ahead of them to come over and be part of Forerunner. And we really, I think that we have gone out to raise funds with the top down, bottom up approach. So the top down has been like, what's going on in the market? Where do we think the opportunities are? Like, if we could invest anywhere we wanted, where would it be? And then we try to reconcile that to like, what do we have the skill set to do? What do we have the reputation to do? What do we have the team and the process to do? And I think that like that kept us really diligent about making sure that we were always staffed to effectively deploy the capital that we were raising. I haven't ever gone out to raise with like a promise of like, oh, we're going to hire these people once we raise this fund. We have got that team in place in front of it. A mantra for us has been like, let's put our startup hats on and recognize that our ambitions and our ambitions for our product and market are going to be, you know, greater than what we're resourced to. So that's just on us to be that much smarter and efficient about how we work. And let's figure out what are the things that like we really have to do, like what's table stakes to be good at this job. And then what is the one thing that we can do to stand out in the market? Not the 5 things or whatever, but like the one thing we can do. And let's try to like staff and organize our team for that. And the subtext in that is like, can we do that with a fewer amount of people? So I really value and really want to have a team. I also really value the closeness in which we work together, sort of the fluidity of how we interact. And I don't judge a level of success by how many people we have working for us. I judge it on like how good our output is and like how efficient we are at driving that output. And so that's, you know, every time I think we just raised a fund, we sit down and say, okay, what are the 5 areas or the 6 areas that we need to like, we'd like to beef up or bolster up, or we'd like to be good at, we put them down, and then it's like competing for resources. Okay, but we're only going to add 2 of them. So where is the most leverage exists in each of those? And that's allowed us to be, you know, incredibly intentional about who we're bringing onto our team, how they're going to contribute to the team's success, how existing team members will value new people coming in. And I'm always thinking about like, what opportunity are we creating for each other? You know, not every junior investor that we bring in is going to be able to be a partner because it's just impractical. But I think that there should be, you know, the availability of the learning curve and the exposure for everybody who's here working hard, and maybe we will be able to create enough opportunity to kind of meet everybody on their career ladder. That would be great if we could, but part of that is being like that much more deliberate about fewer people working more specifically.
So I want to go back through the list of questions that I had come up with before to make sure I didn't miss any, and also sort of going through the chat, just picking up a couple of things before we let you guys go. Question about some of the earliest yeses. First on the kind of, you know, your angels or syndicates and you know, the sort of pre-institutional. What was it that you think got some of those people over the hump? And on the flip side, was there anything that you thought people were going to be impressed by that actually like didn't turn out to be that good of a pitch?
I think the thing that resonated for me with the investors that I pitched early on, what you asked for the angel investors, not the institutional investors?
The very early, yeah, the angels.
I have an answer for the institutional, but for the early angels, like I was saying earlier, like I pitched deals, not Kirsten.
Right.
You know, so, and then by the time I pitched Kirsten, I had a list of deals.
And I had that experience too. I definitely had more interest once I got into a few things post my first close, because when I first raised my fund, the biggest question was, were the deals that I did at first round, which was a successful track record of like 8 or 9 deals that had a bunch of exits, were they first round deals or were they Charlie deals?
Right.
And that was the big question. Like, could I get into things on my own? And like, I knew that answer personally because I knew how I got those deals, but I had enough empathy to understand that from the outside looking in, like you wouldn't really know whether that was just, you know, Josh handing me a scraps or, you know, however that went. And so, but once I started to get into things and I could talk to how I got them and all of that sort of stuff, I definitely picked up some more momentum, even though those deals, like, you know, they were doing fine, but it wasn't like they were huge 10x markups. They just, the fund itself felt like it had some more momentum.
Yeah, I'll share a story, and hopefully this answers, it may not answer your question directly, but there was a hedge fund manager who we went to pitch to invest in our fund, and we knew for certain he would invest because he was just very, very wealthy. And we went into his office, we thought like 100 grand would fall out of his couch. And so Nambi and I pitched our heart out to him. And at the end, he said, I'm not going to invest, right? And he said, but follow me. So we went and navigated his big office to some corner. And he showed us a picture of him and his co-founders. It must have been like 15 or 20 years in the past. And under that picture was a set of core values. He said, I'm not going to invest, but you should write core values. And if you do, I will spend a tremendous amount of time with you to do that. And so Nambi and I left, and we were walking down the street, and we said, man, I just can't believe this guy didn't even put like 100 grand into the fund. Like, that's nothing for him. And we said, well, let's take him up on this core values thing. And so this guy spent an enormous amount of time with us constructing these core values, which actually was probably one of the biggest investments in our firm, because it created a way of operating, a way of investing in people, like Kirsten described, that allowed us to start to attract a lot more capital. And so even though that was an early conversation and it was a no, in retrospect, it was probably one of the first investments in the firm. It was just non-capital investment.
Gotcha. So one question that sort of came in on the side is talking about deal sourcing and deal flow. You go in, you say, hey, I'm going to find these great deals. Did you feel like you had enough flow and that you were raising the fund to just take advantage of that? Or were you raising the fund to go out and build flow? Because a couple of people in the audience are sort of sitting there like, yeah, like I've seen a few deals and maybe I've pulled a few checks, but like I don't know if I have the flow to do a fund right now because I'm not working on the fund full time. Like, because I don't have the team, because I don't have the capital. Like, why would I have the flow? So how did you guys think about what kind of flow you had before you raised?
It was, for us, it was there. So Nambi has started to make some seed investments, and we would warehouse like 2 or 3 of his investments. So he was demonstrating he can come from the growth stage and go earlier by making seed investments. I was on the ground as a seed investor.
And so just so everybody knows, warehousing. So you put deals in the fund that you were hoping somebody else would come into the fund because you were kind of a little bit over your skis, maybe a little bit on the deals that you were doing on the fund.
So Nambi was building his own personal track record by making investments. And we said, okay, you have deal flow over there. We will acquire some of those investments when we raise our fund. So that was a demonstration that there was access to deal flow. When I was at DFJ and also helping to build Cornell Tech, there was just a lot of deal flow I was around. So by the time we had our first close, there was investment opportunities there for us. Our first investment was a company called Iterable, which is now valued at $2 billion. That was our first company that we invested in at the seed round. We did their seed because it was a deal that was there kind of waiting for us because we were around a lot of deal flow.
And I think that's an exercise that I tell people to try and do. If you're thinking about raising a fund, imagine you had a fund for the last 4 years. What deals could you have legitimately gotten into, or 4, 5 years, 6 years, 7 years, where you were around them, and that, an LP could call them up and say, hey, if Aaron had a fund 5 years ago when you were first raising, like, did you know him? Like, would you have taken money from him? Like, all of that sort of stuff to sort of approximate what your deal flow might have been like. What about you, Kirsten?
I definitely did not have any prolific deal flow. That was not something that I was out advertising. What I did though was I had my past individual things. I had some people who were like, okay, Kirsten's serious about building something. We'll cobble together this $5 million. Then I put together a portfolio of companies, and I was like, my go-to-market was to take a narrow view of the market. Like Forerunner now has an aperture where we say the consumer or the user is our North Star. And we really come at most of the things we're looking at from the perspective of those behaviors, creating tailwinds. and we invest across a spectrum of businesses. But when I first started and it was me as a solo GP, I might have cut that big swath and then said, for right now, I'm going to work on like these couple of companies that are changing the landscape in commerce. Here's the angel investments I made out of my fund. And LPs would call those founders and be like, why did you let Kirsten in? She was nobody from nowhere. And they'd be like, well, she knew retail and the rest of the tech investors didn't, or whatever the case may be. So I had that. And then I did something which, I mean, it could have been stupid, but in retrospect, it worked out well for me. Dollar Shave Club was out pitching to the institutions up and down Silicon Valley, Sand Hill Road, and they weren't getting any term sheets. But people were like, yeah, there's this angel investor over there that thinks these things are interesting. Like, we don't invest in these things, but we like your video, dude. So we'll give you an angel check. I mean, he got all these angel checks from all of these GPs at firms, but nobody was willing to lead the deal. And so somebody said to me, like, oh, you want to invest in this razor company? Have you seen it? And I said, I haven't seen it, but that sounds kind of, no, I don't want to. And then I met Michael like 2 days later at a dinner, and I really talked about, he shared his vision for the business, and I thought about like where I'd been thinking about the transformation in the ecosystem. And so I went and borrowed $250,000 from somebody else, and I led that deal. Because I mean, listen, like, I didn't have any money. Led that deal, and I was like, is this a good thing or a bad thing that I just went against the grain from like what all these other GPs are doing, because people think it's cute little deal or whatever. But it gave me something to talk about with LPs, because they were like, why would you do that deal? And I really got into like, here's why this business is interesting to us. This is what I see that maybe other people don't see. And I think that ended up being a very good hook for me.
Can I just drill into that just a little bit? Because we got like a couple college kids sitting here in the audience and all of that sort of stuff. When you say you borrow, right? Is this like personal loan, house as collateral, or were you doing a deal on behalf of somebody else where you like shared the economics in some way?
No, never shared that, but I did go to one of those people who were part of like, been invested in those other consortium of things, and said, I'm raising this fund, as no one had committed. I want to do this deal as the first one in the fund. I don't have any money to do it. You can do your investment early. Give me $250 and you're going to invest anyways in the fund. Right. If I can't close the fund, then you can have this deal. Gotcha.
Okay. So you weren't going to like lose your house.
No.
If the fund, like, it was basically you did your bottom line loss was that you did an angel deal on behalf of somebody else, and you just would have been
that I wasn't going to get anything out of it.
You weren't going to get anything out. Okay, gotcha. That seems a lot safer than taking a loan out. Gotcha. But still, I mean, super aggressive and awesome. But
I think for me at the time, like the most aggressive thing was like I realized kind of like simultaneously while I was doing it, I'm like, oh, a lot of people have passed on this deal. So like, are these LPs going to be like, oh, listen, like all the smart people that we've already backed are passing on it. Like, what's she doing? But, like it was a conversation starter.
For sure. Last two questions before I let you guys go. And I appreciate all the time you've spent with us thus far. Kirsten, you said you had something that your first institutional backer saw in you. And so I would love to know what it was that you thought convinced that first big check to take a chance. I'd asked you about
I showed up, to my first, institutional meeting with a data room and a couple of like, thesis decks, like market research, like framing the opportunity, pretty specific on like what I was going to go after, what the landscape was, to really demonstrate like an awareness of the market and a point of view. I had, made a bunch of angel investments. I had investment memos for all of those. I had founder references for all of those. And I had a business plan. I never was going to just raise a fund and be Kirsten doing deals. Like I wanted to build something. So I've always treated Forerunner like the startup that we try to invest in with other people, which are like, what's the big idea here? Like, how are you going to be different in the market? And then like, what's this chapter? What are you proving this chapter? What are you proving next chapter? And I think I was just, I know I was like really deliberate about like raising a fund to build a firm. And so I think, like, to your point, you said, Charlie, like, people aren't looking at one fund, they're looking at two funds, like LPs, like, you know, institutional LPs, like they're like, they're portfolio managers like we all are, right? They can't invest in everything. They've got to pick a handful of 20. And it's not just a by fund, it's like their whole roster forever. So they are thinking about, like, where am I going to be able to kind of grow and put money over time? And what risk am I taking early on for that opportunity that might present itself as this partner firm team demonstrates themselves? And so I think, you know, kind of me stepping up with that, with a vision and a commitment to, this is what I want to do, people could think about, not only was this fund going to be successful, but was this going to be something they could invest in over time? And that might have teed the conversation in a way.
Aaron, what tipped the scales, do you think, for your first big LP institutional check?
Yeah, I mean, it's very, very similar, actually. So we have this idea internally called keeping people in orbit, right? So when we went out to raise our first fund, which was the proof of concept fund, we ended up talking to a lot of large institutional investors, all of which said no. But that was okay, because they became a part of what we call our orbit. And so we would engage with that orbit and like in a regular cadence, right? So we would send out quarterly reports. We started having annual meetings. And so they could actually start to see the evolution and feel the evolution of our firm. So this one large institutional investor, while we were out raising our first institutional fund, or what became our first institutional fund, got an invite to our annual meeting. And at that annual meeting, we had Ken Chenault, who was going to speak. So we had convinced Ken Chenault to speak at this annual meeting. And so this large endowment reached out and said, well, hey, you know, whenever you're in town, let us know. Would love to learn more. And so we reached back out and said, we'll be in town next week, right? And so we went out there to their offices, and we sat down and we walked them through what we were building, not what we were building at that moment in time, but what we were building over time. And just like Kirsten said, they were surprised when they looked under the hood, because we just said to them, the only thing we want you to do is look under the hood, right? Because they were saying to us, a very small percentage of managers ever even get our capital. And we said, that's okay, just look under the hood. And when they looked under the hood, they saw something, saw infrastructure that much larger funds just didn't have at the time, because we were so intentional and deliberate about what we were building from the very beginning. When they looked, it was very, very much robust and thoughtful. And they took a chance on it, investing in that.
Awesome. Thank you guys so much for spending the time. I know you guys both have hard stops, so really, really appreciate it. Congrats on getting to this point, and thanks for spending your afternoon with us. I really appreciate
Thanks,
it.
Charlie, for organizing this, and thanks, everybody.
No problem.
Aaron, good to see you.
Always good to see you.
Okay.
Yeah.
Bye.